Why gold is stuck at $3,300 for months. Gold has hovered around $3,300. To most people, this looks boring. But in markets, boring is often the calm before the storm. When gold pauses at such high levels after a rally, it is usually building energy for the next big move. This is known as a flag formation in technical analysis. First, the price shoots higher, forming the flagpole. Then, it moves sideways, forming the flag. It looks as if the market is catching its breath. But when the breakout comes, it is usually explosive. The question is whether the breakout will be up or down. And while both are possible, the evidence overwhelmingly suggests the next big move will be upward. The psychology of a flag formation. A flag pattern reflects investor psychology. The sharp rally brings in momentum buyers. Then, as price consolidates, impatient traders leave, weak hands are shaken out, and big players accumulate more. When the breakout finally arrives, it is violent. Short sellers rush to cover, sidelined investors scramble to get in, and momentum accelerates. The result is a surge that often overshoots even the boldest predictions. Right now, gold's 3,300 consolidation looks like a textbook case. Historical parallels. History shows us what happens when gold consolidates like this. In the 1970s, after the US left the gold standard, gold drifted sideways around $100. Then inflation and global instability pushed it above $800 within a few years, an eightfold increase. In 2008, gold hovered near $900 before the financial crisis. As banks collapsed and the Fed slashed rates, gold soared past $1,900. 2020, during COVID, gold paused around $1,600, $1,700 before exploding above $2,000 as governments unleashed stimulus. Each time, the sideways action fooled many into thinking gold was done. Each time, it was only the beginning of a massive rally. The present setup looks remarkably similar. Why an upward breakout is more likely. Fundamentals strongly favor a surge higher. Here's why. Geopolitical chaos, wars, political tensions, and global mistrust are rising. When uncertainty dominates, investors seek safety. Gold has always been the ultimate safe haven. Seasonal cycles. Summers are quiet, but autumn and winter bring volatility. Energy crises, elections, and international tensions often erupt when the weather gets colder. This winter could be especially turbulent. Monetary policy shifts. Trump has made it clear he wants lower interest rates. Current Fed Chair Jerome Powell is resisting, but this won't last forever. Once Powell is replaced with a Trump-aligned candidate, aggressive rate cuts are likely. Lower interest rates weaken the dollar, and when the dollar falls, gold rises, often dramatically. The Fed, Trump, and the coming rate cuts. The tug-of-war between Trump and the Fed is at the heart of the story. Trump believes rate cuts will fuel growth and markets. Powell wants to maintain credibility and keep inflation under control. But politics often wins over principle. Once Powell is replaced, and that moment is coming, markets will price in deep rate cuts. That will send the dollar lower. And when the dollar weakens, gold shines. This has happened before. Every US rate-cutting cycle in history has been accompanied by strong rallies in gold. This time will be no different. Central banks are buying gold at record pace. Perhaps the biggest driver of all is what central banks are doing. For 14 years in a row, they have been net buyers of gold. But in the past 2 years, their purchases have exploded to record highs. China, Russia, Turkey, Poland, India all are rapidly increasing their reserves. Why? Because they no longer fully trust the dollar. The US has weaponized its currency through sanctions. Countries fear their reserves could be frozen or devalued overnight. Gold, by contrast, has no counterparty risk. It cannot be defaulted on, frozen, or printed. It is neutral, timeless money. This quiet but powerful shift in reserves is pushing gold demand to levels unseen in modern history. The dollar's waning reserve status. The US dollar has been the world's dominant reserve currency for nearly 80 years. But cracks are forming. The BRICS nations are actively building alternatives. Energy trade is increasingly conducted in yuan, rubles, or even gold. Bilateral trade deals are bypassing the dollar. Every empire in history eventually faces decline. And as the dollar weakens, gold strengthens. Investors see the writing on the wall, and they are preparing accordingly. The decline of treasuries. For decades, US treasuries were considered risk-free. But today, America's debt has surpassed $36 trillion, and interest costs are spiraling. Investors are questioning the sustainability of US debt. Central banks are selling treasuries and buying gold instead. This represents a massive structural shift. Gold is not just an asset, it is becoming the alternative foundation of trust in global finance. Gold versus cryptocurrencies. Some argue that Bitcoin is the new safe haven. And while crypto has value and potential, it remains far too volatile to replace gold as a global reserve asset. When crises erupt, institutions don't run to Bitcoin, they run to gold. Central banks don't buy Ethereum, they buy bullion. Crypto is a bet on the future. Gold is a protection for the present. Both can coexist, but only one has survived every crisis in human history. Why winter will bring market storms? This coming winter could be especially volatile. Energy shortages, elections, escalating wars, and economic slowdowns all point to higher uncertainty. Markets are calm now, but that calm is deceptive. Like pressure building beneath the surface, the quiet will eventually give way to chaos. And when fear dominates markets, gold thrives. The 3,300 consolidation is not weakness, it is strength. Gold is holding firm despite temporary calm and a strong dollar. When conditions shift, the breakout will be violent. Gold as the ultimate insurance. Investors need to understand, gold is not just an investment, it is insurance. You don't buy fire insurance because you expect your house to burn down tomorrow. You buy it because you know the risk exists. Similarly, you don't buy gold because you expect collapse today. You buy it because you know the system is fragile. The wealthiest families, the smartest investors, and the most powerful nations all keep gold as a hedge. That's not by accident. It's because they know that when everything else fails, gold endures. What this means for investors. What should you, as an investor, do now? Understand that 3,300 is not expensive when viewed historically. If gold surges to 5,000 or higher, today's price will look like a bargain. Smart investors prepare before the rocket launches. Waiting until the breakout begins means chasing at much higher levels. That doesn't mean putting all your wealth into gold. But ignoring it entirely in this environment is reckless. Even a modest allocation can protect wealth in times of chaos. Let's summarize. Gold has been consolidating at 3,300 forming a flag pattern. History shows such consolidations precede explosive rallies. Fundamentals, geopolitical chaos, central bank buying, US debt, and rate cuts all favor an upward breakout. The dollar's dominance is waning, and trust is shifting toward gold. This winter promises greater volatility, making gold's role as a safe haven even more critical. Gold is not standing still, it is preparing. And when the breakout comes, it could be historic. If this helped you see things differently, drop a comment and we'll answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit. It moves.